Hey everyone, this is Kirk here again at optionalpha.com, and in this video we're going to go through options pricing and the Greeks. Now I can tell you honestly, this is actually one of my favorite parts about trading. I'm just a numbers guy by nature, and I can tell you that this is by far the number one distinguisher between those people who are successful in this business and those who aren't, is understanding how options are priced, understanding the Greeks, how implied volatility and time decay and all of that stuff impacts an options price. Because if you understand that, then you'll understand where we get our edge in trading. And we're going to be going over this a little bit more in some other video tutorials further down in track 1. But today we're going to dive really deep into options pricing so that you guys have a clear understanding of it. So first of all, trying to predict what will happen to the price of a single option or position involving multiple options as the market changes can definitely be difficult as an undertaking. So it's really hard. It's easy with stocks, right? You know what's going to happen with the value of a stock because you can see it visually, right? That the stock value goes up or the stock value goes down. With options, there's so many different components that factor in. It's hard to understand sometimes what is really impacting the value of that option. So like we said, because the option price does not always appear to move in conjunction with the price of the stock, it's important to understand what factors contribute to the price of an option and the effect that they have. Option traders often refer to delta, gamma, vega, and theta of their option positions. This is collectively called the Greeks, and they provide a way to measure the sensitivity of an options price to quantifiable factors. Now, it's really important that you realize immediately that the Greeks do not determine pricing, and this is a big misconception that people have. Greeks don't determine pricing. They just reflect what could happen in option pricing changes for moves in stock, implied volatility, time, etc. Okay, so Greeks are forward-looking. They are not a determinant of option pricing. They basically tell you if this happens, then the price of the option should go down or up by X. Okay, so they're like little levers. So if you push this lever, then you'll get this reaction. If this happens in the stock, you'll get this reaction. And that's a big misconception that some people have. So again, before we talk about the Greeks, let's dive a little bit deeper into overall options pricing, which builds on the concept you've already learned earlier in this course and track 1. All right, so here's the deal. And the way that I always think about it is like this, and this is what we kind of created here for you guys, is that options pricing. So the price of an option is basically broken down into a couple different categories, and then we'll kind of get a little bit further and deeper into the Greeks. Now, we've already talked about intrinsic versus extrinsic value. I think we did that on the last video or the previous video inside of track 1 here, talking about in the money, out of the money, and at the money options. But basically, you can break down an options price into two broad components, and that is intrinsic value and time value. Intrinsic value, again, being the value of the option right now if it were to be at expiration. So does it have any value right now based on the spot price or the stock's price and your strike price? Meaning if you have a 50 strike call option, so your strike price is at 50 and the stock right now is at 55, you know that you have $5 of intrinsic value in that option right now because you can buy it at 50 and immediately sell it at 55, okay? So that's the first component of option pricing, is this intrinsic value. And again, that's just simply looking at the difference between the stock price and your strike price, whether you're on the call side or the put side. Now, the other component of options pricing is time value. Now, this is the one that always kind of trips people up. Most people get intrinsic value, but this time value aspect really has a lot to do with how option prices fluctuate in addition to the movement in the underlying stock. Because we know that the intrinsic value is going to move as the value of the stock goes up and down. That's just a straight linear relationship. But this extra component here, this time or extrinsic value, that's a little bit different. So that factors in things like time to maturity. So how long is it before expiration? Typically, options that have a long time before expiration are more highly valued because there's a long time for that contract to be out there. Options that have a low time until expiration are typically lower valued, all things being equal. Volatility, again, this is the key right here. I can tell you right now, if you've watched any of our videos here, or if this is the first video that you're watching here at Option Alpha, I am telling you right now that volatility is the key to everything that we do here as a trader and trading options. It is the number one most important thing that you can master. And volatility, when it comes to options pricing, just basically means that when the markets are more volatile, so when there's high volatility, then option pricing is high as well across the board. Calls, puts, everything on both sides. When there's high volatility, option pricing goes up as well because a rising tide raises all ships, meaning that when the markets are really volatile and swinging back and forth wildly, then each strike price has a better chance of being hit. When volatility is really low or dropping, then option pricing as a result goes down. And when markets are really low in volatility, meaning they're just kind of moving sideways, they're not really, making those huge moves like a high volatile market. In low volatility markets like that, then option pricing is low because then those further out of the money strike prices don't have a high chance of being hit. The market just doesn't move all too much. Then the last thing that really affects the value of an option is the rate of interest or interest rates. This is rho. We don't usually talk about this. Well, I'll kind of briefly cover it right here, but we don't usually talk about it as kind of like the main four Greeks. And rho really affects options that are really far out in date. So just like time to maturity and just like volatility, as the contract expiration is further and further out, we're talking 6 months, a year, 2, 3 years out, then interest rate impacts will have a bigger impact on the value of that option. For what we do here at Option Alpha and what most traders do, trading inside of 60 days, the impact of interest rates is non-existent almost. So we don't really cover it as kind of like a main Greek, but it is there, just so you guys know. Okay, so that's kind of like the basics for options pricing. Now let's dig a little bit deeper into the actual Greeks, and we'll kind of relate this back to the things that we just talked about. So again, options pricing broken down into those two main categories, then all the ones below. Now we have the Greeks, okay? And again, we have basically the four major Greeks, delta, gamma, vega, theta, and then we have rho, which is the interest rate one as well, okay? Don't want to discount that. Don't want to assume that's not there. It is, but doesn't really impact shorter maturity options. So again, delta is now going to give you and show you that relationship for intrinsic value. Okay, this is basically what delta does. It gives you the relationship to how much money you're going to make for that particular strike price based on any particular movement in the underlying stock. And again, we'll go over each of these individually with a lot of examples too. Okay, gamma doesn't really have a connector here, but gamma is related to delta. So gamma is considered basically the rate of change or the acceleration amount of delta. So it basically shows you that next dollar amount, how much more are you going to make for that next dollar, and then the next dollar, and then the next dollar. Vega is very easy to remember. Vega and theta are very easy to remember because I always think V, vega, V for volatility. So vega is going to tell you what the impact is on that option for a 1% change in volatility. And again, that's all things being equal. What happens to the value of that option should volatility go up or down by 1%? T for theta is time to maturity. This is basically going to tell you how much the value of that option decays every single day as it gets closer to expiration. Remember, options are wasting assets. As they approach expiration, the theta decay, as it's called, or the time decay, starts to accelerate as it gets closer to expiration. Time is running out. The clock is running out. And so the value of the options go down dramatically as we get closer to expiration. And then again, we have rho, which is the rate of interest. Okay, so let's get a little bit deeper here and talk a little bit more about delta. And we'll go through delta, gamma, theta, and vega and go through some really clear examples using some live pricing at the time I'm doing this video. Hopefully that really helps kind of clear things up for you guys. So let's first talk about delta. Delta is one of the biggest ones you'll probably hear. We talk about it here generally, not too often, but we will talk about delta a lot, and you'll definitely see it on your broker platform. Now, delta is the amount an option price is expected to move based on a $1 move up in the underlying stock. Now, the key here is that the delta is always based on an upward movement of the stock. It's always based on a $1 move, no matter if it's a $500 stock or a $2 stock. It doesn't matter. It's always based on a $1 move and based on a $1 move up. Now, naturally then, call options have positive delta between 0 and 1, meaning that if the stock moves up, that is always good for long call options. And then vice versa, put options always have a negative delta between 0 and negative 1. That doesn't mean that they are bad. It just means that when the market is moving up, then it negatively impacts put options. But when the market moves down by $1, then it would positively impact a put option. Okay, so that's basically the textbook definition, if you will, of delta. But let's really kind of dig deep here and look at some examples. So this is my live broker platform Right now we're looking at GDX. Why GDX? Because I just typed it in and we're just looking at it, okay? The stock right now is trading, and its live time is trading at 2060, okay? This is an ETF for gold. So it's live time trading at 2060, and I've got 2 contract months open. I've got the April expiration and I've got the May expiration. Now, April expiration has about 24 days to go. May expiration has about 59 days to go. Okay, so this is going to help us show the differences in how some of these numbers are going to shift and change and move as we go further out in expiration or closer in expiration. Okay, and then again, we have some of the weekly contracts that are in between here as well. All right, so let's actually go in here and start looking at some deltas. Now, the first thing I want to do is I want to look at these 21 strike call options for both April and for May expiration. Again, I'll just highlight it here so you can see it a little bit more clearly and focus in on it. But inside of our platform, at least on Thinkorswim and most broker platforms, you have all the different Greeks here: delta, gamma, theta, vega. You can change these things. And again, we're working on just the call side right now. Now remember, delta is going to tell us how much money we make or lose based on a $1 move up in the stock. So right now, the delta of the 21 strike call options is 46.46. And what this means is that if the stock goes $1 higher from where it's at right now, so from 2062 to 2162, all else being equal, all things else being equal, then this value of this option contract is going to go up by $46. Now, the current value of this contract is about $74. This is a bid and the ask spread here. So it's currently valued about $74. So if the stock goes up by $1, then this option contract should go up by $46. Okay, so again, you can see the impact that delta has. It kind of gives you a barometer for how much money do I make for every $1 move up in the stock. Again, now as we look out towards the May expiration, you can see that there's a bigger impact in May for the same underlying move because there's a little bit more time left until expiration. So again, still the same $1 move up in the stock from where it is right now, 2060 up to 2160. That gives you a $49 increase in the value of the option. Okay, those options out of May are a little bit more expensive because of a bunch of different factors, which we'll continue to talk about. But those options have a lot more time decay, a lot more volatility baked in, and are going to profit a little bit more from a quick move up in the underlying stock. They cost more upfront, but they're going to profit a little bit more, a couple dollars more, for a $1 move up in the stock. Okay, so that's on the call side. Now let's look at the put side of the trade at the same 21 strike puts. So the same 21 corresponding strikes, but now on the put side. And you can see here for delta that all of the deltas are negative. Now, that doesn't mean that you're always going to lose money. It's just remember that delta is telling you how much money you make for a $1 move higher in the underlying stock. If you owned the April 21 strike puts and the stock moved up by $1, the value of your contracts would go down by 54 cents. So right now they're valued at about $1, $1.12, $1.13. They would go down by $54. Now that also means that in the reverse, you would make money. So if the value of GDX actually went down by $1 instead of up, if the value of GDX went down from 2060 to 1960, then you would actually make $55. Okay, so it's just the complete opposite. If the value of the stock goes down with put options, then you make this delta, which is 0.55, okay? On the call side, again, the same relative thing is going to happen here. You can see that the delta is negative 51 on the 21 strike puts for May. That means if the value of GDX, the stock itself, goes up by $1, we lose $51. If it goes down by $1, we make $51. Okay, so hopefully you can see how that relationship starts to interact with each other. Now, one thing that you'll want to point out is that obviously the value of in-the-money options is always going to have a higher delta than out-of-the-money options, okay? And again, remember that delta is more of your intrinsic part of options pricing. It basically bakes in the intrinsic value of those options that are already existing, meaning how much money could you make if expiration was today. And you can see that any options that are in the money, both on the call and put side, any options that are in the money have higher deltas, whether they're higher negative or higher positive. they generally have higher deltas approaching 1 and -1, which is basically parity with the options. Any options that are out of the money usually have lower deltas because they're not going to be as responsive to a dollar move in the stock as something that's in the money. So if you bought a 23 strike, let's say call, that's way out of the money, and a dollar move up, it's still not going to be in the money. So a dollar move up from the stock of 2060 up to 2160, you're still not going to have your stock price above your strike price or have an option that's now in the money. So that option is going to be less responsive and is going to profit less than something else that is a little bit closer in. Again, these options are always cheaper, so the market is always fair and efficient with how it prices its options. All right, so let's move on here and talk about gamma. Now, gamma is a little bit different. Remember, gamma is going to be related and kind of tied into delta. Gamma is the rate of change in delta based on a $1 change in the stock price again. So if delta is the speed at which option prices change, or how much you make or lose, then you can think of gamma as the acceleration. So options with the highest gamma are the most responsive to stock price changes in the underlying security. The way that I think about gamma, because I know it's hard and I'm trying to give you guys as much information as possible. The way that I think about gamma is I think about gamma as the additional profit or additional loss for the next dollar. That's how I think about it. And so let's go back here again to GDX and we'll kind of use an example here. Okay. So if we were looking at, let's say, these options now, we'll kind of just move around here to challenge you a little bit on option pricing. So if we were looking at the 22 strike call options in April, the delta for these options is basically 30. All right. So let's round up so we have round numbers here. It's 29, but it's basically 30. Okay. So that means that if GDX goes up by $1, the first dollar from 20.56 to 21.56, you make $30. Okay? If it goes up another dollar from there, so from 21.56 to 22.56, you'll make another $30 plus the additional dollar is going to get you another $15 of profit. So the first dollar that you make, or the first dollar up in GDX, you basically take in $30. The second dollar, or now $2 higher, you take in an additional $45 for that move higher. Okay? So you can see that as the stock rallies, your profit potential, at least with call options, as the stock does rally in your favor, you have an opportunity to kind of compound a profit here in a small snowballing fashion. Okay, and again, it can work in the complete opposite. So if the stock moves down by $1, so again, let's use this example here. It works complete opposite. If the stock moves down by $1, you lose $30. If the stock moves down by another dollar, so now it goes from 20.57 down to 19.57 down to 18.57. Then you lose another $30 plus another $15. So now you're losing even more money as the stock goes down as well. Okay, so I don't want you to think that it only works in one direction. It's definitely a two-sided market, obviously, and it works in both directions. And again, that rate of change is just showing the incremental impact of the delta and the underlying stock move. Now, in this case with gamma is always positive, and it just means the additional money made or lost. So on the put side, if you're looking at, say, the 22 strike puts, if the stock moves down by $1, you make $71. Remember, on the put side, we want the stock to go down, and that means we make money. If the stock goes up, we lose $71. But if the stock goes down, we make $71. If the stock goes down by another dollar on top of the first dollar, then we'd also make another $71, check, and we'd make an extra $15 on top of that. Okay, so that's how you want to think about that. Gamma is the additional money made or lost for each incremental dollar higher and lower. And now notice, what's really important about gamma is that gamma is always highest when it's centered around at the money strikes. Okay, so generally speaking, gamma is highest when it's centered around the at the money strikes. As you go further out on each end, notice how gamma goes down. And that's because you're getting away from being either an intrinsic value or extrinsic value, right? So that's why gamma is lower at the further extremes, because it's not going to have as much of an impact on the actual options price. What's really going to have big impacts is when the option is trading right around its strike price. Okay, so hopefully that makes sense, and hopefully that kind of clears it up with All right, so the next option Greek that we want to talk about is theta. Theta is time decay, or is really the enemy number one for option buyers. On the other hand, it's usually the option seller's best friend. And as option sellers here at Option Alpha, it is one of our best friends to have theta or time decay working to our advantage. Now, theta is the amount that the price of calls and puts will decrease every single day as the option approaches its expiration. Remember, option contracts are wasting assets. They decay in value until they reach their intrinsic value at expiration. That means that every day they are wasting away. I think about it like a bucket of water with a slow drip. And slowly over time, that slow drip is going to empty the value of those options. That's why we generally prefer to be option sellers, because of this wasting approach to option selling. So again, let's go back here to our GDX example, and we can look at some theta inside of here. I always do that on accident. I open up GarageBand instead of my marker. So you can see here, this is theta. And again, it's negative in all cases for all options, out of the money, in the money options, everything. Theta is always negative for options, and that's because options are always a wasting asset. There's no example in which option theta would not be negative. But remember, theta is going to be really, really small far out because the option has a lot of value. As we get closer and closer to expiration, theta really speeds up. So just to give you a really good example of this, we can look at a couple different contracts here. These are the March contracts that expire in 2 days from now. And you can see that the 21 strike call options have a theta of -4. When I go out to the 21 strike call options on the April contracts, which have 24 days to go, you can see that those are only losing $2 per day, or have a theta of -0.02. So again, this is the every single day decline in the value of the option, regardless of what happens in the underlying stock, because it's getting closer to expiration. So when I look at these April expiration options and this 21 strike call, you can see that every single day, no matter what happens, this option is losing part of its value, $2 per day, to time decay. Okay, and again, that's going to happen every single day, and that's going to accelerate and speed up, because you can see here as it gets closer to expiration, now it's losing $4 a day, and probably somewhere in between here around maybe like 17 or so, or $10 10 days, you can see now it's starting to lose $2 to $3 per day. Okay, so that time decay aspect is really, really crucial. You have to understand that if you are trading too close in, that theta decay means that your option either has to be make it or break it. It's either got to make money or not, because if it doesn't, then you're going to lose a lot of value from those contracts just purely on the decay in the options as they near expiration. Now, same thing goes on the reverse. Obviously, the further out that you go, the theta decay is really limited. You can see these options all the way out in May, they're losing just about $1 a day. Okay, that's pretty much the lowest that they can lose and the least amount. That means that the value of these options are going to pretty much hold up until they start getting really under 45 days. That's when it really starts to speed up. All right, so the last option Greek that we're going to talk about here is vega. Vega is my personal favorite. I believe that this is where we make all of our money as an options trader. It's understanding the relationship between implied volatility, historical volatility, and how options are priced. Okay, and we'll get deeper into this as we go through our edge training here in a couple sessions on the beginner track here at Option Alpha. So vega is the amount that a call or put price will increase or will change for every 1% change in implied volatility of the underlying stock. Okay, so again, it's always based on a 1% move up in implied volatility, and it basically shows you how much money you'll make or lose if all else stays the same, everything else stays the same, and implied volatility goes up. Now, vega does not have any impact on the intrinsic value of the option, because again, it can impact the kind of like the further out stretches, because it doesn't really matter if the stock moves. It's all based on implied volatility in the market. So it doesn't have any impact on the intrinsic value of the option and only affects time value of an option's price. Now, that said, IV is the most critical element of an option and the options pricing model, because it's the only unknown option. It's the only unknown component. So when you really think about this, okay, the options market knows almost everything to determine the price of an option. So going back to this options pricing chart here, to determine the price of an option, we know almost everything. We know the current stock price, check. We know the strike price in relationship to the current stock price. That's a given. So we know intrinsic value immediately. We know how much time is left until maturity. We would know what the interest rates are, right? The only thing that we do not know is how volatile the stock is going to be in the future. This unknown becomes our edge. This is the one component, as I mentioned numerous times before. If you've listened to anything that we've done here at Option Alpha or read anything that we've published, you know that this is the number one component that you have to understand if you want to be successful trading, because it's the unknown and therefore it is our opportunity to make money. It's our edge in the market. So again, all these other factors can determine options pricing except for volatility. So how does implied volatility work? Well, basically, without getting too much into it in this video, because we've got a lot of other videos that we can go through, but implied volatility basically works by assuming how far a stock will move in the future. So basically what happens is that the options market basically determines its own implied volatility, or the market participants, based on how active and how much they want to price an option, or how high or low they want to price it, they determine how volatile they expect the stock to be in the future, or the ETF to be in the future. You can see here down below with GDX back here in November, at least the time that we're doing this video, there was pretty low volatility in the market. So market participants were not expecting GDX to make a really big move. And as a result, over the last couple months, as it headed toward a really big move, market participants got that part right for a couple months. But you'll notice that they started to shift and change their perspective, and you'll see this big jump in implied volatility. And this is, again, it's all based on current market participants. It's not based on any necessary formula or relationship to the stock price, to expiration, or any of these other things. It's based on how active people are buying, how aggressive they're buying options on either end, how far out they're doing it, the prices that they're paying. But you can notice that there was a meaningful jump in implied volatility, meaning the market participants expected GDX to be fairly volatile sometime soon in the future. And then you can see once that jump happened, you can see exactly that the GDX basically doubled over in a matter of 2 months or so, from around $10 to around $21. And you can see that market participants kind of fairly accurately, predicted that move. So it's this implied volatility factor that is unknown. So we don't know exactly what the stock is going to do, but we do know that market participants can expect a big move out of the stock, or can expect a little move out of the stock. And having high implied volatility basically gives all option prices a higher value. Having low implied volatility gives all option prices a lower value. So going back to our trade tab here with GDX, when we look at vega, again, which is volatility, we again see that vega is pretty much a constant on both sides and is positive, because it's always looking for that 1% move up in implied volatility. Okay, it doesn't just like delta, it's always looking for a $1 move higher. Vega is always looking at the next 1% move higher in volatility. So if we look at, again, the 21 calls, and with a vega of 0.2, if volatility in GDX increased by 1%, regardless of where the stock moved, regardless of if it's closer to expiration or not, just a 1% move up in implied volatility causes the value of this option to go up by $2. Now, in most cases, volatility moves by a couple percent, usually 5 or 10 or even 20% over a given week. So if we're looking at a 10% move in volatility, we're looking at a $20 increase in the value of this option, and nothing else had to happen. The stock could stay exactly the same. We could be in the same day. Between now and expiration is the same time. Everything else being equal, just a rise in implied volatility, or the market expecting the stock to be more volatile than it was before, causes an increase in the value of these options. Now again, just like time decay, the value of these options is going to be more dramatically impacted the further we go out, because as we have more time until expiration, volatility going higher creates a bigger opportunity for the market to swing into a zone that we could make some money in. So again, if we go back here to GDX, and if we're looking at these expiration dates, this is the April expiration date and this is the May expiration date out here. If the stock market is really volatile, but we only have options until May, there's not too much time for the stock to swing into a profitable range. But if we have options all the way out until, in April, we don't have too much time. If we have options all the way out till the May expiration, you can see we've got a lot more time for the stock to move into a profitable range. So in this case, volatility is going to more dramatically impact those options that are a little bit further out in time. Okay, and we'll be going through a lot more case studies and looks at volatility, especially in the coming up videos here, where we talk about historical volatility, so what actually happens versus implied, because that's really how we kind of gain our edge as option sellers. Now remember that the Greeks, like we said before, are just snapshots in time. What's more important to realize about options pricing is that the impact of future time decay and volatility can have a huge impact on option pricing, more so than the underlying position and how it moves. We've proved time and time again and posted many live trading videos that showed where the stock moved completely against us, where we did not get the directional assumption right, meaning we thought the stock was going to go lower or higher, and we were totally wrong. But the impact of time decay and volatility and understanding those components made us or put us in a position where we could take a profit on a trade, even though we had the underlying direction completely wrong. Okay, so Greeks are just snapshots. They move every single time that the market moves. The Greeks are basically recalculated and always moving as we get closer and closer to expiration. So I know this has been a long video. Hopefully it was incredibly helpful to understand options pricing. If you have any comments or feedback, I'd love to know. Add them in the comment box right below this video. If you loved this video and thought it was helpful, please share it online, spread the word on social media. Help us help you by getting other people involved in options trading. It's one of the ways that we grow here through organic referrals from people like you. Until next time, happy trading.